Welcome to FP&A Insights. I'm Jack Alexander, and a little bit about our program here as we get started. My objective here is to share my 50 years of experience as a CFO, advisor, author, and lecturer with the next generation of finance professionals. These are short, focused sessions on important topics. I'm developing several playlists listed there, including FP&A and business analysis, all the way to career development and financial leadership. And many of these topics and models, illustrations are based on my latest book, Financial Management, Partner in Driving Performance and Value, on the top right-hand section there. And that book comes with a free website that has these models as well. So if you like this, go ahead and like and subscribe, and hopefully you'll find this of value. So today's topic is going to be rolling forecasts and extended business outlooks. It's part of this business planning playlist, and the topics we'll cover today are the evolution of budgets, what is a rolling forecast, extended outlooks, the benefits of these devices, how do we get started, and then I'll share with you my personal journey with these topics. So going back in time, back into the 70s and 80s, really, when I first started, we used to do a budget every year. It would begin probably in July and with a call for a plan, and it would go for a long period of time into November or December. These budgets were based on detailed estimates, went out to department managers to fill out budget reports. They were really developed by finance, for finance, general ledger focused, didn't really get into customers, projects, transactions the way most managers view the business. Many of the assumptions and drivers are buried in detail, and all inputs are treated equal. So labor and office supplies were given the same level of attention, even though one was 60% of the cost base and the other one was less than 0.5%. Also involved multiple iterations, long elapsed time, and substantial time, both finance and non-finance staff. One of the principal problems with these is they ignore the presence of uncertainty. So going through time here, we had a lot of things change in the world from that original budget mindset, which worked well. It was largely a stable environment. Business models didn't change that frequently. We started to think of them in terms of being operating plans and really focusing on operations. And then a lot of stuff happened in the 70s. We had oil crisis. We had a lot of conflicts. We had rapid inflation. And so businesses started developing contingency plans and updates. These were event-driven, and they required essentially a redo of the plan. And then in the 80s, large public companies especially, began developing forecasts, which were updates, not complete redos of the budget, but updates of the plan, so that they could see what was on the horizon, and especially public companies to update shareholders. This then led to the idea of rolling forecasts and business outlooks, our topic today. And these are really important because we have to recognize that all projections are tainted by uncertainty, as Yogi Berra famously said. Okay, so what is a forecast? So going back in time here in the 80s, oftentimes we would prepare forecasts. So we would do a plan here in 2020, and then we would update that, and we'd have a quarter of actual, and then we would forecast the rest of the year. And that forecast period got shorter and shorter, down to 1 quarter after we closed the third quarter of 2021. And that's really kind of silly. Why do we forecast 4 quarters and then we drop all the way down to 1 quarter? And we don't really have a good solid look into the next year, 2022 in this case, until we begin to develop the 2022 budget. So what is a rolling forecast? A rolling forecast is always projecting 12 months or 4 quarters into the future. And so what happens is, as we close out one quarter, say the first quarter of this fiscal year, we would add the first quarter of the next fiscal year. So again, we're always looking 4 quarters out. So these have to be robust and flexible. They can't be redos of the budget process. We need to focus on key assumptions and performance drivers. And there has to be a comprehensive view of performance. It can't just be the P&L. We got to look at the balance sheet and cash flow as well. A number of early advantages we can point to, and we'll talk more about this in a moment, is it provides an early view into and management engagement of future results. A big benefit is that it will wind up reducing the effort in the annual planning process because we've already addressed many of the major issues and changes. It also facilitates scenario planning analysis and eventually will become the cornerstone of our planning activities. So how do we implement a rolling forecast? We have to have a new mindset. We have to rise above the detail. We have to see the big picture, as it were. And this is a problem for many of us in the accounting and finance profession because we're taught to look at the details, to reconcile, to solve things to the penny. We have to step away from that orientation, see the big picture. We need to incorporate the Pareto principle, the 80-20 principle, into our thinking. So I recommend reviewing our current operating plans and management reports. And in doing so, we have to identify the major critical business drivers. So what are the things that constitute 80% of our cost model? The Pareto rule says that 20% of the line items will account for 80% of the dollar value. So we can focus on things like labor and perhaps material costs and not so much on the smaller items. I like to look at the most variable, and we can identify those by looking at the major causes of variances to our forecast and plans in the past. Is it pricing? Is it the price of oil? Is it the price of some other commodity? Is it foreign currency? Whatever the case might be. And then we want to think about what the critical assumptions are. Not all of the assumptions, but what are the critical assumptions? And then think about identifying the significant future drivers. So what are some of the drivers that will affect future performance? Things like the timing and success of new products. Are we going to do any acquisitions? What cost reductions or restructurings might occur? What about product life cycles, where a product that was contributing at one level last year is going to mature and not contribute as much into the future? We also want to look at identifying one-time items so that we can determine the base performance trends. And so one-time items might include things like reserve activities, legal settlements, non-recurring revenue. And again, we want to focus on developing this base performance trend. We can think about designing architecture. To some extent, that can wait later, but we want to focus on those critical drivers. We want to optimize the trade-off between detail versus summary. We got to make sure we explicitly call out and incorporate assumptions. And then, this may seem overwhelming, but we can start with a simple paper analysis, or better yet, an Excel analysis to get started. So the practical implementation would be to start with an 8-quarter or 12-quarter trend schedule with history and then 4 quarters of projections. And then we'll go ahead and develop a supporting schedule perhaps for each significant financial statement caption. And then, of course, we can revise these and improve on them based on our experience. So starting with this analysis, we have a trend by quarter of last year's results. We've got 2 years of 2 quarters of projections here for the current year, and our outlook is limited to the rest of the year. So if we simply think about developing a forecast, a projection for the following 2 quarters, we can just go ahead and basically talk about what's the minimal amount of information we need to extend that planning horizon, and we can look at the trends that are contained within the previous 8 quarters there, what items can be easily extrapolated from recent trends, and what factors might influence future performance. And we likely would develop, as I mentioned before, a supporting schedule for things like revenue, cost of goods sold, SG&A, marketing. And I like to limit those to one page so that we group all of those non-important, non-significant, non-variable items into one line analysis, and we really focus all of our attention on those things which are the largest and also most likely to vary in the future. Performance drivers really need to be focused on in all projections, and so we want to think about always revenue and margins need to be considered. And I think 80% of any organization's activity in developing and reviewing projections should be around revenue and margins. You can see other significant cost drivers, human resources, commodities, macroeconomic factors. Look outside the organization as well. What are the major investments, and what are the risks and upsides to the assumptions that we've made? My journey with extended forecasts began in 1985, so that's over 40 years ago, with a large publicly traded company. I was a division CFO, and because the corporation needed to provide investors with earnings outlooks for the next year, we were required to develop a rolling forecast. No experience, no software, very little guidance. And it started with a whiteboard exercise. It started with that high-level P&L trend schedule. We extrapolated from a prior year base and thought about what might change in the future, identifying those future increments and decrements. And in fact, we had a large non-recurring revenue in the past year, and we also had a major competitive threat. And so that forced us and allowed us to communicate effectively with the corporate team that those were not going to recur, and that we had a major competitive issue, which when we began to lay into the rolling forecast, forced us to fully grip with the impact that we were going to face as a result of lower margins and lower volumes. We experienced some immediate benefits. It accelerated our understanding of the major drivers and the impact on business performance. It unified leadership and management and developed a view of the future direction and actions that were required. It also provides for the maximum response time, since you're identifying earlier than you might otherwise would, and it wound up reducing significantly our annual planning cycle. The extended outlook is a variation of a rolling forecast because some organizations find it cumbersome or not intuitive to forecast an additional quarter each cycle. So it's not intuitive because most managers are more comfortable with a full year view, and the quarters lack a full year context. So an extended business outlook, and I use the term business outlook rather than forecast because words are important. It shifts the focus from finance to a business outlook. We're always going to be forecasting the rest of this current year, and we will be forecasting the following year. And so this makes it easier because we've got that context of a full year, and it provides the greatest outlook in terms of the duration of the forecast. And so I have migrated to this approach over rolling forecasts because it is easiest and really doesn't require substantially greater effort. So what are the benefits? We focus our attention on business drivers and critical assumptions. We reduce effort and surprises in the annual planning process. Again, this early identification of trends and business issues is really important. And a bonus, a complete surprise, it wound up significantly reducing our effort in the annual business plot process because we had 80% of the grit done when we started the annual process. We got to overcome barriers. So a lot of organizations fail to understand or articulate the potential benefit Of course, all human beings have a resistance to change. A big one is the accounting mindset, this perceived need to replicate the annual budget and the detail orientation. We got to step up. Perceived resource requirements and the absence of technology are always excuses that come up. I find that you can start very easily with that simple Excel model that we talked about before, the 12-quarter trend analysis, and go from there and build on it. So I don't think that excuses are very worthy in this day and age, and we have to find a way around it. Before you invest a lot of time hiring people, implementing new technologies, give it a shot on paper or on Excel so that you really understand what you'll be trying to do. So, in summary, rolling forecasts and outlooks, in my opinion, offer significant benefits. We need to focus on critical business drivers rather than all items, and we have to develop a practical implementation path. And I'll close off by saying, if I joined a company as CFO today and they didn't have a rolling forecast or extended business outlook, we would have one within 30 days. Thanks for listening. I hope you find it useful. Please like and subscribe and watch some of the other videos that we have in this playlist.